If you think the next financial break will arrive with a siren, a speech, and a neat little warning label, you still do not understand how money blows up. A real break begins with a number that still looks manageable, 5% down, 8% down, a few missed payments, a few gated redemptions, a few executives saying the problem is isolated, a few television experts telling you to stay calm, keep averaging in, and trust the system. That is how the machine warms up. I have spent most of my life studying capital, and I will tell you something ordinary people hate to hear. Markets do not usually die from what is visible. They die from what is carried off the books, renamed, repackaged, relabeled, and sold back to the public as sophistication. When people lose money in a plain old bad business, that is painful. When they lose money in a black box wrapped in prestige, that is a different animal. That is not just a loss. That is a trust event. That is when the machine turns on the people feeding it. And that is why I want to talk to you about private credit, because a great many people are treating it like a yield product, a diversification sleeve, a clever institutional corner of finance, when in many cases it behaves more like a shadow machine. A shadow machine is simple. It borrows confidence from one room, manufactures valuation in another room, and sells reassurance in a third room. The public never sees the gears. That is the attraction. The public sees the smooth metal on the outside, the brochure, the monthly mark, the famous name, the polished conference panel, the phrase alternative income, the promise of downside protection. The illusion that volatility disappeared because price discovery disappeared. That is not safety. That is darkness mistaken for stability. You need to understand the difference because your life runs on exposure whether you admit it or not. Your paycheck is exposure. Your retirement account is exposure. Your bank deposits live inside a balance sheet that is exposure. Your house price, your job security, your ability to refinance, your emotional calm at the dinner table, all of it sits downstream from systems you probably never voted for and do not control. So when I tell you a shadow machine matters, I am not talking to hedge fund managers. I am talking to the school teacher, the mechanic, the office worker, the nurse, the small business owner, the retiree who thinks the danger lives only on Wall Street. Remember, the danger lives anywhere. Cash flow meets leverage and honesty starts getting replaced by imagination. That is where the machine begins. Most people think a crisis starts at the moment of collapse. I think that is backward. A crisis starts when bad incentives become profitable. The collapse is just the receipt. I saw the broad outline of this long before many people wanted to hear it. Not because I am magical, not because I can predict dates, and not because I have some mystical crystal ball. I saw it because the machine always leaves the same fingerprints. First, a difficult environment shows up. Then a product appears that claims to solve the difficulty. Then the product grows too fast. Then the language around it gets smoother than the economics beneath it. Then standards bend. Then transparency declines. Then ordinary people are told not to worry because the smartest people in the room are handling it. Then those same people start using one pool of money to defend the appearance of value in another pool of money. Then someone says redemptions are temporarily paused. Then someone says the issue is contained. Then somebody discovers contained is another word for connected. That sequence is older than the people currently selling it. You do not need to memorize every acronym in modern finance to understand the danger. You just need to understand what happens when the system runs out of good borrowers, but still has an endless appetite for loans. That is where the machine becomes hungry. And a hungry machine does not suddenly become moral, it becomes creative. Let me make it plain. A traditional bank is supposed to behave like a filter. It takes deposits, evaluates credit, says yes to some borrowers, says no to others, prices risk imperfectly, and tries to survive. That process is not glamorous, but it has one virtue. It is visible enough to be criticized. A shadow machine does something else. It says the filter is too restrictive. It says there is money being left on the table. It says public markets are noisy, regulators are clumsy, and banks are conservative relics. It says private lenders can unlock opportunity. Sometimes that is true. Then greed arrives and ruins the sentence. Because once enough capital floods in, the mission changes. The machine no longer asks what deserves a loan. It asks, where can I place money fast enough to keep the story alive? That is the shift that matters. The public thinks the machine exists to finance businesses. In reality, the mature version of the machine exists to finance itself. That is when it stops being a lending system and starts becoming an appearance system. The distinction is everything. You work in the real economy, the machine works in the narrative economy. In your world, a company either earns enough to service debt or it does not. In the narrative economy, a weak loan can be bundled, delayed, cross-held, marked softly, talked around, and carried as an unrealized success, while fresh capital fills the hole. In your world, gravity is immediate. In the machine, gravity is negotiable until suddenly it is not. That is what ordinary investors keep missing. They mistake delayed gravity for no gravity. I have no interest in scaring you for sport. Fear without structure is useless. I want you to see the mechanism. So let us walk through it like adults. Imagine a healthy borrower walks into a bank. Steady income, real collateral, some operating history. The bank makes a loan. Fine. Now imagine a weaker borrower walks in. Thin margins, shaky cash flow, questionable prospects, the bank declines. That used to be called discipline. Then the shadow machine enters and says, I will take what the bank refused, but I will charge more. Again, in moderation, that can be a legitimate business. But the machine does not stay moderate. Because money chases yield the way heat chases oxygen, when safe returns disappear, investors do not become patient. They become vulnerable to stories. And the most expensive story in finance is always the same one. Higher return, low volatility, limited correlation, institutional quality, expertly managed. No need to worry. That sentence has emptied more pockets than most recessions. Once that pitch works, money arrives faster than prudence. Then the machine faces its true problem. Not how to analyze risk, how to absorb assets. That is when standards weaken, then structures multiply. Then side vehicles appear. Then funds own positions in other funds, then the marks rely on models, then the models rely on assumptions, then the assumptions rely on management narratives, then management narratives rely on the absence of forced pricing, then investors say the monthly report still looks stable. Of course it does. A thermostat can show 72 degrees while the wiring behind the wall is burning. The monthly mark is not the reality. It is often just the temperature the machine wants you to read. I want you to hold that in your head because it explains a great deal. Public markets can be cruel. They can humiliate you in real time. But they also confess quickly. A shadow machine confesses late. That lateness is what fools people. They compare a public stock that falls every day with a private asset whose mark barely moves and conclude the private asset is safer. Maybe one price is honest and the other one is on a controlled drip. You cannot build wisdom on delayed information. You can only build comfort. And comfort is expensive when leverage is involved. Now step back and ask the bigger question. Why does this matter now, in this particular moment? Because stress rarely comes from one direction. If all you had was a private credit system, stretching standards, the machine might keep limping for a long time. But markets crack when several pressures begin working at cross purposes. You have inflation pressure from one side. You have labor weakness from another. You have central banks forced into ugly trade-offs. You have yield curves sending signals many people prefer to ignore until after the damage is done. You have banks and non-banks connected through funding lines, credit lines, reputation lines, and ownership webs. You have investors who still think diversification means holding many labels inside one underlying system. That is not diversification. That is cosmetic separation. When I look at a vulnerable cycle, I do not just ask whether one asset class is overdone. I ask whether the machine depends on conditions that can all reverse at once. Cheap funding, benign defaults, steady confidence, continuous inflows, flexible marks, calm headlines, low refinancing pressure, complacent depositors. If the machine needs all of those conditions to survive, then it is not resilient. It is spoiled. And spoiled systems become hysterical the moment discipline returns. That is where psychology enters the picture. A bubble is not just a valuation event, it is a behavior event. People start borrowing beliefs from each other. That is what television does. That is what cocktail parties do. That is what financial social media does all day long. One person says, the smartest funds are in it. Another says, institutions are increasing allocations. Another says, the returns are steady. Another says, it is not like 2008. Another says, this is a modern structure. Another says, there is dry powder. Another says, redemptions are limited by design. Another says, volatility is lower. Another says, there is too much capital on the sidelines for this to become dangerous. I have heard versions of all of that before. The language changes. The delusion does not. What really traps people is not greed alone, it is emotional outsourcing. They stop doing the uncomfortable work of judgment and rent conviction from the crowd. That is how fragile people start feeling sophisticated. I want you to notice something about your own mind. If an asset goes down every day in public, you feel fear. If an asset stays flat in a private report while the underlying economy deteriorates, you feel relief. Relief is not evidence. It is just the emotion produced by slower recognition. The machine lives on that delay. It feeds on your need to believe somebody somewhere has already done the hard thinking. That is why the machine is dangerous. It is not just a financial structure. It is a psychological anesthetic. And anesthetics are wonderful right up to the moment you wake up in the middle of the surgery. The old financial crisis taught people one lesson they partly remembered and one lesson they forgot. The lesson they remembered was that mortgages can blow up. The lesson they forgot was that opacity plus leverage plus incentive distortion can wear many costumes. Subprime was one costume. A private credit labyrinth can be another. The names change. The mechanism rhymes. When the public hears that a major institution has exposure, many people shrug. They think exposure means a modest line item on a spreadsheet. Sometimes it means the machine has branches inside branches, claims on claims. Financing backed by marks derived from positions that themselves rely on fresh money and favorable assumptions. That is not an investment thesis. That is a circulation system. When circulation depends on confidence more than cash realization, you are closer to a trust product than a productive asset. That matters because confidence does not decline in a straight line. Confidence snaps. That is why financial accidents always appear sudden to people who are ignoring the setup. The setup can last months or years. The snap takes a weekend. You can watch this dynamic in markets over and over. At first, every dip is framed as an opportunity. Then every delay is framed as patience. Then every gate is framed as prudence. Then every rescue line is framed as liquidity management. Then every markdown is framed as idiosyncratic. Then the whole system discovers it has been using euphemisms as collateral. Let me translate the language for you. When a manager says the assets are long-term in nature, ask whether that means buyers disappeared. When somebody says marks are model-driven, ask whether trades are scarce because reality would be embarrassing. When somebody says investor access is being managed carefully, ask whether withdrawals expose the fiction. When somebody says contagion risk is low, ask how many balance sheets are quietly linked through financing, derivatives, shared counterparties, or common psychology. When somebody says private markets are less volatile, ask whether truth has merely been granted fewer appointment times. This is not cynicism. This is adult supervision. You cannot allocate capital well if you refuse to interrogate the sentence hiding underneath the sales pitch. Now let me move from the machine itself to what it does to the person trapped near it. Most people think financial danger is a portfolio issue, too narrow. The deeper damage is that a fragile system changes your behavior before it changes your statement. A worker in a shaky credit cycle becomes more obedient. A family carrying too much debt becomes easier to scare. A retiree dependent on flattering marks becomes less able to think clearly. A banker staring at soft assets and hard liabilities becomes defensive. An employee in a business dependent on refinancing starts confusing activity with durability. This is why I care so much about ownership and refusal power. Refusal power is the ability to say no because your life is not financed by panic. That is one of the highest forms of wealth. If a machine can force you to keep working when you should walk away. Keep investing when you should reassess. Keep borrowing when you should simplify. Keep pretending when you should tell the truth. Then the machine owns more of you than you think. Most people measure wealth by visible consumption. I measure it by strategic independence. A fancy life with no refusal power is just a decorated cage. A modest life with strong cash reserves, low leverage, rational expectations, and patience is much closer to freedom. That may not sound glamorous on television. I do not care. Glamour is usually what people buy a few years before they start using words like reset, restructure, bridge financing, temporary liquidity, or unforeseen headwinds. The machine has another trick, and you need to see it clearly. It creates false hierarchy. It makes people believe that because a fund has a large name, a polished board, a thick document set, and institutional investors nearby, the underlying economics must be disciplined. Number prestige can distribute bad judgment just as efficiently as panic can. Sometimes more efficiently, a nobody selling fantasy gets questioned. A famous machine selling fantasy gets allocated. That is one of the oldest fraud premiums in the world. I am less interested in whether every participant inside the system is malicious than whether the incentive map rewards optimism, delay, and selective disclosure. That is enough. You do not need cartoon villains when the structure itself pays people to keep the belts moving. Once the belts are moving, everybody gets tempted. The manager wants fees, the investor wants yield, the bank wants volume, the advisor wants a sale, the executive wants marks that keep the board calm, the borrower wants one more extension, the regulator wants no immediate fire on his watch, the media wants access, the public wants reassurance. That is how a machine acquires political protection without a single formal conspiracy. Everybody wants tomorrow to arrive before today gets marked, honestly. That is what makes the unwind so ugly. It is not just financial, it is moral. Reality is trying to collect from a system built on negotiated delay. Now add macro pressure. This is where people make the mistake of isolating a credit issue from the rest of the economy. Suppose energy costs rise hard enough to squeeze margins. Suppose labor weakens enough to hit confidence. Suppose inflation refuses to die exactly when growth starts to wobble. Suppose central banks find themselves trapped between stabilizing prices and stabilizing demand. Suppose funding costs stay higher than the machine expected when those loans were originated. Suppose refinancing windows narrow. Suppose banks become more selective. Suppose investors stop sending new cash with the same enthusiasm. That is when the shadow machine starts eating its own wiring. A loan that looked serviceable at one rate starts gasping at another. A valuation that looked plausible under optimism starts looking theatrical under scrutiny. A fund that relied on staggered exits discovers everyone wants the same door. A bank that assumed it had distance from the problem discovers it was lending to the machine, warehousing the paper, financing the vehicles, or ensuring the confidence. That is how modern contagion works. Not through one giant headline alone, through layered dependency. This is why I pay attention when markets start drawing strange historical echoes. I am not saying history repeats like a machine stamp, it does not. I am saying human overconfidence repeats with irritating loyalty. People forget that before a major break becomes obvious. It looks silly to the crowd. Warnings look exaggerated. Comparisons look dramatic. Precaution looks timid. People say the world learned its lesson. What they mean is they memorized the last costume and stopped watching for the next one. That is not learning. That is nostalgia dressed as wisdom. I have no interest in nostalgia. I care about sequence. What comes first? Usually not bankruptcy, usually denial. Then rolling weakness, then increasingly strained explanations, then selective freezes, then markdowns, then revelations, then correlation, then emergency language. Then the public discovers that private calm was never the same thing as private safety. By the time that lesson gets learned, the machine has already transferred a large amount of damage from the careless to the unsuspecting. That is what makes me unforgiving about these structures when they become too opaque and too celebrated. They do not just threaten rich speculators, they distort capital allocation for everybody. Good businesses compete with subsidized mediocrity, disciplined lenders compete with fantasy marks, workers compete in an economy where weak enterprises survive longer than they should because financing remains artificially soft. That delays cleanup. It also delays truth, and delayed truth is an invisible tax on honest people. I call that the silence tax. The silence tax is what you pay when institutions postpone recognition and ordinary people keep living as if the balance sheet beneath them is sound. You pay it through inflation risk, you pay it through job insecurity, you pay it through lower real returns, you pay it through stress. You pay it through years of being told to average in while the machine redistributes fragility across the system. This is why I do not worship complexity. Complexity often exists to charge a higher fee for lower clarity. A simple business with visible earnings and durable economics can hurt you if you overpay. A complex black box can hurt you even when the reported mark flatters you all the way down. One injures you by price, the other can injure you by truth lag. Truth lag is one of the most dangerous forms of risk because it gives you time to build larger exposure under the false comfort of stability. That is why people feel betrayed in these episodes. They were not just wrong. They were calm while being wrong. That combination leaves a scar. Now, I want to tell you what not to do, because during a dangerous cycle, the crowd always reaches for the same bad habits. Do not confuse averaging down with courage. Sometimes averaging down is just repeated denial with better branding. Do not confuse a famous sponsor with a clean asset. Do not confuse low reported volatility with safety. Do not confuse complexity with intelligence. Do not confuse income with durability. Do not confuse diversification across labels with diversification across mechanisms. If 10 products depend on cheap leverage, soft marks, and continuous confidence, you do not own 10 independent ideas. You own one crowded assumption wearing 10 suits, and do not wait for the last confirmation before you clean up your life. The last confirmation is where the price of prudence gets repriced. People always want certainty before action. That desire is understandable and expensive. In markets, certainty usually arrives after opportunity left and after danger fully priced itself in. You do not need certainty. You need asymmetry. If the upside from denial is small and the downside from fragility is large, the rational move is not heroic prediction. It is disciplined positioning. That is true in portfolios and in personal life. Maybe the shadow machine breaks in a spectacular way. Maybe it only grinds into a long balance sheet recession. Maybe it creates rolling damage instead of one giant weekend collapse. I do not know the exact movie script. I do know the economics become less forgiving when weak credits, opaque marks, elevated funding costs, and macro pressure begin leaning in the same direction. I also know that your response should not depend on whether television chooses the phrase crisis. Television is not your risk manager. Your neighbor is not your risk manager. Your advisor may not be your risk manager. Your own appetite for reassurance is certainly not your risk manager. You are. So what does intelligent behavior look like when a shadow machine is humming in the background? It starts with inversion. Instead of asking, how can I squeeze a little more yield from a strange structure? Ask, what in my life depends on things going exactly right? That is the better question. What in your life breaks if your hours get cut? What in your life breaks if refinancing gets harder? What in your life breaks if your portfolio is marked honestly instead of politely? What in your life breaks if a bank tightens? What in your life breaks if energy costs stay high longer than expected? What in your life breaks if the job market weakens while asset markets stop forgiving mistakes? These are not pessimistic questions, they are ownership questions. A real owner studies fragility before chasing upside, then simplify, reduce unnecessary leverage, build liquidity that belongs to you. Not liquidity you think a gate might someday release. Favor assets you can understand over stories you can only repeat. Favor businesses with real cash generation over structures dependent on perpetual refinancing. Favor counterparties that can survive embarrassment. Favor managers who speak plainly about risk instead of managers who perform confidence-like theater. Keep enough reserve that you are not forced into humiliation when prices move against you. Preserve your ability to wait. Waiting is not passive when it is funded. Waiting is one of the highest return activities in a world addicted to forced motion. And if you are allocating fresh capital, ask a brutal question: where does the cash actually come from? Not the report, not the slide deck, not the model. The cash. Who is paying? Who can keep paying under stress? How many steps stand between the underlying borrower and your statement? How many assumptions must remain friendly for that income stream to stay real? If you cannot answer that in plain English, you may not own an investment, you may own a story on installment. I like plain English because bad ideas weaken when translated out of jargon. A machine that needs darkness to look safe is already telling you something. Listen, now let me say something uncomfortable to people who think this is only about Wall Street products. You may be running your own life with a smaller version of the same machine. A lot of households do. They use salary growth assumptions instead of credit models. They use home price optimism instead of marks. They use future bonuses instead of inflows. They use balance transfers instead of refinancing facilities. They use lifestyle appearances instead of honest recognition. They use social prestige instead of cash reserves. That is the household shadow machine. It looks normal until a shock arrives. Then the entire emotional architecture shakes because too much peace was rented from assumptions. I do not say that to insult you. I say it because the principles are the same at every scale. If you are financing your calm with denial, you are fragile. If you are financing your freedom with leverage, you are negotiable. If you are financing your identity with status spending, you are easy to pressure. The machine outside you becomes most dangerous when it matches the machine inside you. That is when people do the dumbest things. They hold risks they do not understand, because selling would admit the truth. They keep borrowing because stopping would change their self-image. They keep trusting the monthly mark because questioning it would force a life audit. That is how systems reach into psychology and turn finance into behavior control. I have spent a lifetime learning that real wealth is not loud. It is not a heroic return line. It is not a glamorous private allocation. It is not a borrowed lifestyle. Real wealth is a quiet operating system. It lets you think slowly in a fast panic. It lets you walk away from rotten incentives. It lets you ignore the machine when the machine is begging for one more contribution of trust. It gives you the dignity of patience. And patience is impossible when your personal balance sheet is built like a promotional brochure. This is where the worker versus owner distinction matters so much. A worker sells time into a system and hopes the system stays generous. An owner builds claims on productive assets and tries to reduce dependency on any one gatekeeper. I am not insulting work. I have enormous respect for disciplined work. I am warning you that if all you own is a paycheck and a hope that institutions remain honest, you are standing very close to the machine with very little armor. That is not a moral failure. It is a strategic vulnerability, and strategy can be changed. The machine wants you exhausted, reactive, confused by jargon, and grateful for access. I want the opposite for you. I want you liquid enough to think, clear enough to say no, skeptical enough to demand plain explanations, patient enough to hold cash when assets are being sold with too much certainty, rational enough to admit that not every yield product deserves your trust, and proud enough to live below your means long before the crowd discovers why that mattered. Because here is the truth. Most people only learn after a cycle turns. The point of money is not to impress people during the expansion. The point of money is to protect your decision making during the contraction. That is the whole game. A man with a luxury car and no runway is poorer than a teacher with reserves, low debt, and a calm mind. A retiree chasing every offered yield can be more exposed than a saver earning less. But sleeping, honestly, a bank can look large and still be weak. A fund can look smooth and still be unstable. A portfolio can look diversified and still be one bad system in drag. The machine loves appearances because appearances buy time. But time does not erase bad economics. It only compounds them. So I will leave you with the test that matters. Not whether the machine breaks tomorrow. Not whether a particular fund is the first headline. Not whether one chart looks eerily similar to a chart from another era. Those are interesting. The real test is personal. If the marks were honest tomorrow, what in your life would become impossible? If the doors narrowed tomorrow, who would you become? If the paycheck slowed, the portfolio dropped, the refinancing window tightened, and the headlines turned from calm to clinical, would you still own your decisions, or would you start begging the machine for mercy? That is the threshold. That is the door. Most people spend the good years polishing a life that only works in easy conditions. A smaller group uses the good years to build refusal power. One group rents confidence. The other group builds freedom. One group keeps feeding the shadow machine because the monthly statements still look civilized. The other group studies the gears, accepts discomfort early, simplifies before being forced, and protects the right to act from strength when panic finally prices itself. I cannot choose for you. I can only tell you what I have learned when money becomes opaque. When yield gets marketed like gravity disappeared, when institutions ask for trust they have not fully earned, when weak borrowers are being carried by structures too complicated to explain. Honestly, when macro pressure starts leaning against financial engineering and when the crowd is still calling that sophistication, you are not standing near an opportunity nearly as often as you are standing near a machine looking for fresh hands. Do not put your future inside a machine you cannot explain. Do not hand over your piece for an extra point of yield. Do not wait for the collapse to become official before you decide to become harder to break. The machine will take as much of your life as you finance through convenience, image, and denial. The question is whether you are going to keep feeding it or whether this is the moment you step back. Count what is real, strip away what is theatrical, and build a life that can survive honest prices. That choice is not made in the crash, it is made before the crash. While the machine is still humming, while the marks still look smooth, while the crowd is still comfortable, and while you still have time to decide whether you want the appearance of wealth or the structure of freedom, one of those choices photographs better. The other one survives.